As I was making my other videos, Manulife US REIT has finally announced their recapitalization plan. So in this video, let's go through the resolutions and does it look visible? Because to me, this is a very good lessons to learn when it comes to managing your REITs portfolio. So there are a few important dates to take note of. 4th December would be the deadline for SRS investors to acknowledge or approach their SRS operators with regards to the voting rights. Then on 6th to 7th December is where unit holders are required to approach their respective relevant intermediaries on the votings. And 11th December will be the last day, where 14th December would be the announcement of the results. So let's look at their first resolution, which is to propose the divestment of Park Place to the sponsor at 98.7 million. They mentioned that it's the higher valuation of the two independent valuations. So now, what is my issue with selling of this asset? If you can see this report from the first half of financial year of 23, this Park Place was coincidentally the lowest drop in the valuation at 4.2%. So why is this so? It's because their properties is actually the best performing one, with occupancy at 100% as compared to the rest, which is way below 90% except for maybe Pen asset at 90.9%. So you can see that there's actually a huge difference in the performance itself as well. Well, you can argue that the Park Place is a very small asset compared to the rest at 274,000 net lease asset square feet with only 3 tenants. However, my question will be, why would they be selling this asset to the sponsor where the sponsor can actually help by buying lower quality or lower possible offices? So if you can see from this slide, it's quite interesting because they have actually tiered their assets into 3 different tiers, where tier 1 is with occupancy that is at a high risk, capex at a high risk, and a potential return of a very low category, whereas tier 2 is mostly the medium risk and potential returns, whereas for tier 3 is actually the low risk with medium to high returns. However, to me, Park Place should be categorized under here at the tier 3. So it's quite weird because why is the sponsor buying an asset that is assumingly in the tier 3 category, whereas they could have bought it from the tier 1 category to actually help the REIT. So for the resolution 2, they have actually agreed with the sponsor to have unsecured loans of 137 million. But wait for it, look at this, interest rate at 7.25% with exit premium of 21.16%. So this is an insane value because at interest rate of 7.25%, just to give you a context, average REITs now are currently at a cost of debt of 4%. So at this high value of 7.25%, it would cost their financial expenses to shoot up way higher than expected. So now, there's a few questions with regards to this loan. Of course, it's because of lower S&P credit rating. That's why the yield will be, or the loan will be at a very high interest rate. Because, as I said before in my previous videos, credit ratings is very important for REITs because it determines what are the lender's risk appetite when it comes to lending the money. So, having a lower credit ratings means that you are not as investable to the lenders. So this would make them more riskier when it comes to lending you the money. And of course, they'll charge you a high interest rate because of that. But my question will be, because Manulife is the sponsor and is definitely supposed to support the REIT, why is it that it's loaning at such a high interest rate of 7.25%? And the exit premium is at 21.16% on maturity. So this meant that after 6 years, there will be an additional 21.16% extra payment that is required to pay, effectively causing the effective interest rate at 10% per annum. This is quite remarkable because I feel that this is something similar to the Hyflux situation, where their bonds is issued at a high yield of 7%. So please leave a comment below if I've missed understanding from this resolution. Of course, the use of the proceeds will be used to pay to each lender on a pari passu basis. So what does pari passu basis essentially mean is just to pay evenly to all lenders. So the third and last resolution is disposition mandate. Okay, so what is disposition mandate? Essentially, is giving the Reits managers the power to sell assets at rational prices without the need of EGM approvals. So this meant that they will be given the flexibility to sell their assets as and when without the investor's approval. Of course, they mentioned that the assets are to be sold at no less than 90% of the independent valuation obtained. So, my concern is that what if the valuation actually comes in lower at the year-end valuations that is going to come in soon, because their assets are obviously not performing as well as expected yet. It will continue to decline because their valuations is still higher than Prime and Capital Pacific Old US REIT. So essentially, how they will be selling it will be split into 3 tiers, where tier 1 will be the first assets to be sold, tier 2 will be the following that, and lastly tier 3. So they will do all this transaction until either it expires at 31st December of 25, or the aggregate sales generate up to 328.7 million. Now, this is a prime example of when REITs do not manage their debts well, and when shit hits the fan, things gets nasty. Not only do they have to stop giving out dividends that will cause their share price to crash, but also they are forced to sell their assets at a very cheap valuations, because no matter how it goes, they will still have to sell their assets in order to reduce their debts. So this is what they will be predicting after everything occurs. So there will be a temporary relaxation of financial covenants, because post-capitalization plan will have a gearing ratio of 80%, while their bank interest coverage ratio will actually only be at 1.5 times. So the managers will have 19 months to execute asset disposition in order to pay down their debts based on the disposition mandate if it passed. So what will happen is that their loans actually would decrease by 148.2 million to 875 million post divestment of the Park Place and the 50 million cash and including the sponsor lender loan. So what this means is that including the 137 million that the sponsor loan, they are still having a balance of 875.7 million. So just to give a context, their net property income for first half of financial year 23 is at 55 million. After selling away the Park Place, I expect maybe we can assume that their new NPI will be about 52.8 million. And to take note is that in 2025 they have 130.7 million that is required to be paid at a net property income of 55 million from the last 2 quarters. We can assume that the new half or the subsequent 6 months will have a net property income of 52.8 million after selling Park Place. And that's not assuming that if they sell the other tier 1's assets as well. So what is to take note of is that by 2025 they are required to generate 130 million to pay down the debts in 2025. Of course, that's assuming that they haven't sold their assets yet. Moreover, they also have to account for the high interest debt that they have taken from the sponsor at 7.25%. And you can see from these slides, the financial statement currently is at 56.5% leverage ratio for the assets at 1.8 billion, with the borrowing at 1 billion itself. Whereas after the proposed divestment of the Park Place, the aggregate leverage will drop to 54%. After the sponsor loan, it will drop to 52.8%. And after the divestment of Park Place, sponsor loans, and the tier 1 disposition of the 4 assets out of 10, they will be still left with 49.4% aggregate leverage ratio. And that's assuming that your property valuations do not drop when the financial year end valuations kicks in. So this is just an ideal situation, and my concern is that at this assumed 49.4%, what if the valuation continues to drop? And assuming that it might drop around another additional 5%, this will definitely cause their aggregate leverage to continue to rise and definitely hitting way above 50%. Of course, the bad thing is that if all of the resolution or any one of the resolution is not approved, the existing facilities will remain in breach and lenders have the rights to accelerate the payment of all 1 billion loans immediately, which will cause liquidation of Manulife US REIT portfolio assets. So what can we see from this is that if the unit holders approve the resolutions, they will have to play a very long game and suffering game, because it will be like a loop cycle where the REITs will have to take a very high interest loan to start paying down to finance the new loans, and selling the assets of course to pay down loans as well. This will also bring down their assets even further. However, if unit holders do not approve the resolutions, REITs will be forced to liquidate their assets, which will also be another undesirable situation. So when it comes to investing in REITs, of course it's important to see the situation and the results that the REITs is actually performing. By understanding the results, you will know why the REITs is actually priced at a very high dividend yield, which means it's pricing at a very low share price based on their historically higher dividends. So in this video, I hope that I shared my thoughts on what is my concerns with Manulife US REIT, and I hope that you will also be more aware when it comes to investing in any REITs as well. So please hit the like, subscribe and comment on what are your thoughts with regards to the resolutions as well. Thank you, and I'll see you in the next video.